Good afternoon, and welcome to Blueprint for Clean Energy, a webinar speaker series hosted by the Yale Center for Business and the Environment. My name is Corey Cantor, and I will be your host for today's webinar, titled CPACE, Financing Sustainability While Fostering Economic Development. The Blueprint for Clean Energy webinar series invites leading practitioners and researchers in the field of clean energy to talk about the latest opportunities and developments in corporate, nonprofit, and public-private arenas. In this webinar, Alexandra Cooley will provide an overview and deep dive into elements of property-assessed clean energy for commercial customers, more commonly known as CPACE. Alexandra Cooley, our presenter, is the CFO and co-founder of Greenworks Lending, where she helps small businesses access funding for clean energy projects. Before founding Greenworks Lending, she worked at the Connecticut Green Bank, where she oversaw and managed the development of over $100 million in financial products for deploying clean energy in the state using mostly private capital. One of the initiatives she worked on was developing and implementing the underwriting criteria and capital market strategy for the state's CPACE program. She holds a joint degree from the Yale School of Management and Forestry and Environmental Studies. Before we begin, we would like to remind our listeners that we welcome any questions that you might have, and we'll direct them towards our speaker towards the end of the talk. Please type questions directly into the Q&A window throughout the presentation. And with that, Ms. Cooley, welcome to Blueprint for Clean Energy.
Great, thank you, Corey, and good afternoon, everyone. As Corey mentioned, my name is Alexandra Cooley, and I am a Yale joint degree grad from class of 2012. So this afternoon, I'll be talking about commercial property assessed clean energy, and really it's a story about how public-private partnerships can spur the evolution of new financial products in support of public benefits. And just before I dive in, a quick commercial for Greenworks Lending, so you know who we are. We're a specialty finance company. We're focused on investing in commercial and industrial properties who are interested in using clean energy, so energy efficiency and renewable energy to upgrade their properties, reduce their operating expenses, and become more efficient and sustainable. We use CommercialPACE, it's our main product, and this allows us, as you'll see in my presentation, to make clean energy upgrades a smart business decision for small business owners. So we were founded, Greenworks Lending was founded in 2015, but really we got our start much earlier than that. Both my co-founder, Jessica Bailey, and I started at the Connecticut Green Bank in 2012. And around that time, there was a lot of attention being given to the energy use in the building sector in the United States. This table is from a Deutsche Bank paper from 2012 showing the investment opportunity across the different real estate sectors. And you can see commercial, there's a $72 billion opportunity just for retrofits, not even including renewable energy. And the reason that this was getting a lot of attention is because buildings actually use about half of the power in the country. So when you're thinking about climate mitigation and addressing clean energy, you really have to think about the real estate sector. And at the same time, in 2012, we were on the heels of the financial crisis, and there wasn't a lot of appetite at the public level for making kind of broad sweeping investments, choosing technologies. And so a lot of states and many government agencies were looking for a way to spur investment, but not be the sole provider of that investment into clean energy. Around that time is when property assessed clean energy, or PACE, really started getting traction. PACE is a government financing policy that classifies energy savings upgrade as a public benefit. Things like a sewer or a road or a sidewalk will be additions to your property taxes. And PACE allows private lenders to come in and use that kind of financial technology to create a public benefit on an individual piece of property. So this enables 100% of financing to be provided for clean energy and renewable energy that's site specific and kind of made for that use in that site. And that allows the borrower a lot of benefits and to pay back that loan through a property tax bill. It also enables the periods to match the equipment life because your security is really the tax assessment on the building. And so that allows most building owners to access more attractive capital than they would otherwise be able to attain, and allowing clean energy and renewable energy to cash flow from day one. And that really removes a lot of the barriers that we had previously seen, especially for the commercial sector, to investing in kind of sustainability on their properties and on their sites. Most of the time, there was a lack of funding because most commercial property owners don't have a credit rating from one of the big rating agencies. So a lot of the bank funding they were able to attain would not be 100% 20-year financing. PACE allows them to access that type of long-term 100% upfront cash flow. It enabled them to invest in their building while knowing that the benefit and the obligation would transfer if they were to sell the property. And most business owners tend to sell their properties within 20 years. Not a lot of them stay in one site for that long. Another thing we heard over and over again from the C&I space was that the payback period is too long. Most CFOs are looking at a 1 to 5 year payback period. As many of you know, most commercial energy efficiency or renewable energy projects have longer payback periods than that. Most of them are 7 years plus. When you have financing that allows the energy savings to be greater than the debt service on that upgrade, that means you have positive cash flow not only year one, but day one. And that's very attractive to a lot of building owners. And many commercial buildings are office leases, so tenant occupied. And that creates this principal agent issue where the tenant often is kind of on the hook for the electricity bill, but the owner is on the hook for the CapEx. With CommercialPACE, this enables the owner, because it's a tax bill in many lease structures, to pass through the cost of the upgrades as well as the benefits, so the energy savings and the cost of those savings to the tenants. So the tenants are able to see kind of that incremental savings, and the owner gets an upgraded property. And then many programs, and Greenworks actually requires this as part of our underwriting criteria, many programs also require an independent third-party review of the projects to ensure that the building owner knows what they're getting into and that the energy savings that are being promised are likely to materialize. And this addresses many of the problems we saw when talking to commercial building owners around why they don't install solar or why they don't invest in energy efficiency on their properties. The other thing that PACE does, which was really great from a public sector perspective and from a building owner perspective, is that it's technology agnostic. So this allowed governments to get out of the business of picking winners and into the business of scaling energy efficiency and renewable energy. So you can see this is just a selection of the projects that the Green Bank and Greenworks and other commercial PACE providers have financed, and it's a really large swath. We actually financed our first green roof a couple months ago, so it continues to grow and really allows the energy upgrades to be site-specific and tailor-made to the property owner and the property use type. And then this is really kind of what sells PACE. This is why it's so attractive to the commercial building sector. You can see it compared to other methods of financing or paying for upgrades. And you can see why most building owners tend to let deferred maintenance kind of accrue. If you have $2 million in cash to invest in a multi-measure energy efficiency project, yes, you might be receiving, $300,000 annually in savings, but your cash flow and your NPV is negative. And so you'll take that $2 million, and as long as you can duct tape your HVAC together, you'll hire people or invest in a new product. But this tends to kind of hover at the bottom of the list until something breaks. Same thing for a bank loan. Oftentimes there's an upfront outlay of cash. It's not exactly the full amount, but you are spending money that you could use doing something else to pay for the down payment here. And because the term is shorter, because you have a 5-year term, even though the interest rate, may be lower, the actual payment and the impact on cash for that term is negative. So you're seeing a negative outlay and a negative NPV in cash. And most CFOs will look at this and say, yeah, it's a little better, but we can still duct tape that boiler together. Let's go out and invest in that new product instead. PACE, on the other hand, allows for the full amount to be financed. It allows the payment to go out for 20 years because of that tax assessment mechanism. And that allows the actual payment to be lower than the energy savings and a positive net cash flow. So a lot of building owners will look at this and say, wow, I can upgrade my building and hire people and invest in that new product. This is a great win. So the product has, when compared with other methods of financing, especially in the C&I space, the PACE product was really, is often the winner. And states saw this and said, this is a great way for us to invest very little in setting up a program and meeting our public policy goals around clean energy or around economic development or around energy savings and energy independence. And we really saw a large number of states passing policies around that 2012 time period. And they continue to pass policies. And the nice thing about PACE as well is because it doesn't involve much government funding at all or any, depending on how the state sets it up, you see states on both sides of the aisle passing policy. So this map shows both blue and red states in passing PACE policy and implementing PACE programs. Of course, there's a challenge, and this is where the story of the Connecticut Green Bank and subsequently Greenworks comes into play. With any new financial product, there's a challenge of accessing the capital markets and being able to offer that low-cost financing. It really becomes a chicken and the egg. So you need scale in order to get the attention of the capital markets, which will be able to lend you the money to lend to borrowers at rates around 6%, which is about when you start to compete with the cost of energy. And so the challenge prior to 2012 was that there just wasn't a lot of volume. So if you're an insurance company or an asset manager and you have limited amount of time in the day, and you have the ability to focus on kind of the $1 trillion auto ABS market or the couple $1 million commercial PACE market at that time, you will always focus on the market that has scale, or at least has the potential to scale. And so in order for us to access that low-cost capital and be able to offer the attractive product that we knew that the commercial market wanted, we needed to somehow break this cycle. And that's where the Connecticut Green Bank came into play. The Connecticut Green Bank, I'm sure most of you know, came into being in June of 2012 as it relates to CommercialPACE. They were approved as a statewide administrator, which basically allowed them to standardize the PACE product across different municipalities. And as a sub-program of the Clean Energy Finance and Investment Authority, which was put into place by the governor of Connecticut to pursue multiple strategies to achieve cleaner, cheaper, and more reliable sources of energy and support economic development. So CommercialPACE slotted in really nicely with that strategy. They set up a program that would allow private capital to come in and lend, but before they did that, they knew that this challenge was there, that they had to break this chicken and the egg cycle. And so private capital would come in as a stage 2 to scale as a national footprint, streamline processes, and bring the product to securitization. And the Green Bank did a couple of things that really helped the market get to scale. So first, they created a model of a standardized program that we at Greenworks continue to use as a framework to this date. So when we look at a state, it's really important that the processes are standardized, the legal construct is standardized, because deals from CommercialPACE projects from Connecticut will be bundled with those from Rhode Island and California and Texas. And so the mechanism needs to be fairly standardized, again, to be considered under the umbrella of CommercialPACE when you're going out to market. So there are a couple things we look at, and this is all modeled off of the work that we did at the Green Bank setting up this program. So first is a legal construct. So we'll review the underlying state statute for a couple of things. First is that the PACE assessment, like any property tax or special assessment, doesn't accelerate, which means even if there's a non-payment, the lender can only go after the amount that's past due, not the full amount of the loan, because like a sewer assessment or a property tax, the assessment would pick up with the next owner of the property. Similarly, the kind of other side to that coin is that the PACE assessment must transfer upon sale or foreclosure of the property to the next owner. It can't extinguish in a transaction. And that's what allows us not to accelerate. We also look for the seniority of the lien above the first mortgage. And most of the states that we operate in require the consent of that first mortgage holder to placing the PACE assessment on the property, so that there's no surprises down the road. And the reason they consent is, again, because of this non-acceleration that we look for in all of the statutes. We also will look through the tax collector and foreclosure processes and make sure that even in the operations of those processes, these features are present. We like it when there's a lender consent requirement, because from an underwriting and a borrower protection standpoint, we require it no matter what. So we like it when there's an even playing field. And we also find that from a public relations perspective, the lender consent is really important, not just from the lender's perspective, but also from the borrower's perspective. These tend to be small businesses, and they tend to have very close relationships with their lenders. So we look at lender consent as a borrower protection, but also a credit underwrite as well. Sorry about that. And then we look at cost and operational complexity. It's really important for us that we review the design and administrative structure of the program. We like to understand exactly, we need to understand exactly how the funds will flow. That needs to be standardized. It can't be at somebody's discretion whether or not they'll bill or collect in any given year. It needs to integrate and be consistent with the underlying law. And we look at the cost of administration and the complexity, because complexity adds to cost. And the commercial marketplace in general is very cost sensitive. So we know that if the cost of administration is very high, that will mean that our volumes in that state are very low. And so that's something we're quite sensitive to. And we also like to make sure that there's an approver in place that will say this is a valid PACE assessment according to the law, because that creates rigor in the process. And this was all stuff that the Connecticut Green Bank put into place with their CommercialPACE program, and has since become very standard for states passing policies after 2012. So we tend to see this more and more. We tend to see states being much more standardized after the Green Bank's example. And then, of course, there's the individual PACE asset itself. One of the other things that the Green Bank did was essentially create a test pool of commercial PACE assets. Nobody had seen this asset before. Nobody knew how to underwrite them. There had never been a public rating of a commercial PACE asset, which would then allow the capital markets to start lending against pools of commercial PACE assets. So the one thing that the Green Bank did, or one of the things that the Green Bank did and that Greenworks has continued to do, is look at, okay, this is a very large and diverse pool of borrowers. So the commercial market is actually a very large and very diverse market. It can mean anything from a church to an office building to a manufacturing facility to a self-storage facility to a warehouse, and on and on. It's a really diverse market. And so making those properties all look standardized from the eyes of a lender or from a rating agency has been an iterative process since 2012. And at Greenworks, this is how we think about the world. of CommercialPACE. There are three things we look at. First is the leverage on the property. We have a maximum pace to value that we'll lend up to. That's this lien to value that you see here. We have a maximum total debt to value. That's the pace plus the mortgage. And then, of course, we do require lender consent, which provides a guard against over leverage for the property itself. Second, we'll look at the cash flow and liquidity of the borrower currently in place, and make sure that they're current on mortgage and taxes. This is very similar to how a bank might underwrite a commercial mortgage, but we actually vary this debt service coverage and the elements we look at based on property type. And that's come out of the experience we had not only at the Green Bank, but at Greenworks, seeing a variety of different property types. And then the third thing that we look at is very unique to CommercialPACE. This is the ability for that piece of property to operate commercially, even if that particular property owner isn't in place. So we'll look at property type. We screen out very special use property types. One example might be a very specialized engineering or manufacturing company where the property itself is set up specifically for that operation, and it would cost more than the property itself to modify it for another use. Another thing we look at is location screen. An example here might be a very rural property where it's the only school in the area, and if that school goes away, it's unlikely that the population base is there to support another commercial use in that space. And then the last thing we look at is environmental risk. One of the risks we take in being a lender against the property and not to any particular owner of the property is that if there's an environmental liability that would erode the value of the property over time, it means that that property may sit fallow, and even though our lien is being accrued on the property, we would never get paid out because it would cost too much to clean the property up than it would be worth. And so this is how we approach the rating agencies after 5 years of developing these criteria, and how we standardize the very diverse world of commercial properties. Which brings me to, of course, our recent securitization. Back in September, we were the first CommercialPACE company to securitize a pool of commercial-only PACE assets. And I'll talk a little bit about how we got there. So as I mentioned, the Connecticut Green Bank solved key questions in scaling the CommercialPACE market. So the first was the credit risk. The Green Bank aggregated payment history for 3 years and took the first stab at developing a standardized underwriting criteria. They also proved the operational risk that the tax collectors would actually collect and would actually remit the funds as their agreement said that they would. The other question many investors had was, what was the market for this asset? And through 2012 to 2015, the Green Bank completed 2 RFPs of financing for assets, which really proved to folks interested in the CPACE market that they weren't the only ones out there, and other folks were interested. And that once there was volume, there would be a robust market for buyers of the asset. Origination risk is another big one. So, of course, the whole philosophy behind securitization is that a pool is less risky than a single asset. And so the cash flows look great, but do borrowers actually want PACE? Like how big can the pool get? And the Green Bank instance at Greenworks developed a go-to-market strategy for the small to medium business market and proved that the market was there. And then the last would be liquidity risk. So could these assets be rated? There were a couple sales at the Green Bank and from other CommercialPACE providers across the country, but nobody had securitized it yet. And at Greenworks, that's what we set out to prove, that you could access the capital markets in a scalable way for these assets. This just shows a schematic of kind of the 2 stages. I won't spend a lot of time here because we just talked about it, but this shows a sample of a administrator in a state setting up a program that is scalable and low cost for the market. And then we really saw in 2017 CommercialPACE starting to take off. So you can see that the Green Bank was onto something here. It was the second largest state in terms of CPACE funded dollars, and I think it's the third smallest state in the country. So you can see that it's second only to California, which is a much larger state with a much larger commercial real estate market. And so we were really heartened when we started Greenworks back in 2015, and we've continued to see the growth as we've expanded to other states and as PACE has expanded across the country. We've seen energy efficiency take on a much larger portion of the CPACE improvements by share. And you can see here that a lot of the commercial PACE financings, about 30% are under 750,000. And actually for Greenworks, we have a much more granular portfolio where our average deal size is about $600,000. And so we really target the SMB market. So we expect to see that segment grow significantly. And so in September of 2017, we felt we had aggregated enough assets through 2 years at Greenworks, and decided to go out to market and get the first commercial PACE rating. We worked with Guggenheim, who led the placement of our $75 million deal. As I mentioned, it was the first rated securitization with CPACE only assets. We received a AA rating, which is investment grade, and what we were targeting by Morningstar. And the note purchase was led by Teachers, which is a very large asset manager. And the coupon was 4.09%, so matched where a lot of the other comparable asset classes were, which was a big feat for the first offering of this asset class. So I'll pause there, and I'm sure there will be a lot of questions on our deal, but go into a little bit about what the actual assets look like, because that's the exciting thing for us at Greenworks. And I think probably the exciting thing for most of you on the phone is to see kind of the asset in action. I mentioned that the commercial real estate market is very broad. And so one of the main sectors we work with is manufacturing. This is an example of a manufacturing case that we worked with. It was a solar plus a roof replacement. And it was from DeFeo Manufacturing, which is based here in Connecticut, or sorry, which is based in Connecticut. I think this slide says Maryland. And the total project cost was about $400,000. Their annual assessment was about $40,000. And the annual savings they saw was about $130,000. So almost about $100,000 in their first year of savings, which is an incredible boost to their bottom line. It was great to see a small business here in Connecticut benefit that much from CommercialPACE. Another example would be kind of a Main Street retail shop. This was a pure HVAC upgrade. The owners had a very old HVAC. They were looking to replace not only their HVAC, but also their envelope and their windows. The project was about $135,000. We financed 100% of it. Their lifetime savings was $300,000. That's net of the PACE assessment, and their annual assessment was only $12,000. This was a small town retail shop, and again, really exciting to see them increasing their bottom line just from energy efficiency and being able to get those benefits annually. And then last, I thought that this would be a great project to talk about with this group. I'm sure many of you are familiar with 360 State. Bruce Becker also has a phenomenal project up in Hartford called 777 Main. And this was a former bank headquarters that Bruce was turning into a mixed-use building. They used PACE to finance solar, high-efficiency lighting, and the first PACE-financed microgrid on site. They've got a pharmacy on site, and PACE allows that pharmacy to stay up and running in the event of a disaster. We lent about $1 million, The annual assessment was $43,000 and resulted in a year one savings of about $240,000, which was a really big boost to this development in downtown Hartford, Connecticut. And again, a historic building, which we always love to see. So with that, I'll stop here and hand it over to Corey for some questions.
Great, and thank you so much again, Alexandra. If you're just joining us, we're speaking with Alexandra Cooley on the opportunities and obstacles facing the development of clean energy through CPACE. To kind of recap, we've gone through the origins and implementation of CPACE in Connecticut and across the country, scaling up projects, and the creation of a securitization of this product. We're now going to be moving to the Q&A portion of our webinar. If you have any questions, please submit them through the webinar's question menu, which you should find at the bottom of your screen. So I think, Alexandra, to start off, some of our questioners wanted to ask a little bit more about how Greenworks and the Connecticut Green Bank have worked with mortgage lenders to overcome objections to PACE.
Yeah, absolutely. It's a great question, and we get it quite frequently. The biggest thing, there are a couple things here that have worked very well with mortgage lenders. So first I mentioned the legal construct of PACE. It's very important that it is non-accelerating. So once we approach a lender, almost always their initial reaction is, no, you can't prime my mortgage, I'm in the first position. And the answer to that is, of course, just like a tax lien, the full amount of the PACE assessment doesn't accelerate. So you're only behind 1 year's of payment, roughly, depending on the situation. And then that kind of gets them to pause a little bit, and the benefits of PACE are really outweigh that small amount of risk that they're taking. So I also mentioned the technical review that we do. We're often able to show mortgage lenders a third-party, independently prepared review of the energy savings that will accrue to the property. And what that means is that there is, more often than not, operational savings directly to the building owner that will result in a higher coverage ratio of the mortgage. So the mortgage lenders love that. And then the other thing that it does is it gets them a more valuable asset. So the mortgage lender is, of course, lending against the property. If that property has an old HVAC that is being duct taped together, for instance, that means that the property isn't worth quite as much. So if they're able to upgrade that without burdening the property, because again, they're only behind by that small amount of the amounts past due, that's a win for mortgage lenders. And it's really about telling that whole story and making sure that they understand it. That's how we've gotten most of our consents.
Great. So another question I kind of is along the same lines is more so about your work at Greenworks Lending. In terms of deals, how do they originate? Do projects and customers typically come to you? Is your team kind of going out there and seeking out potential clients? Is it a little bit of both?
Yeah, absolutely. It's a little bit of both. For the most part, we originate through our contractor partners, and we've got a large network of contractors in the solar and energy efficiency space that service the SMB market. We also do some direct to owner. So we'll get inbound calls from developers or property owners who have heard about us through word of mouth. But for the most part, the kind of origination activities that we do are through a network of contractors.
Right. And another question from our attendees is asking a little bit more, I guess, about the third-party portion, about how energy and cost savings from PACE funded projects are verified. So if you could talk maybe a little bit more about the third-party review.
Yeah, of course. So it's typically just a standard energy efficiency review. So they'll look at historic power prices and historic power price escalation and historic building use and project out kind of a baseline case, and then look at the equipment being installed and the life cycle of that equipment, and project out a case with that equipment. And then the difference, of course, is the savings. So it's certainly a lot of projecting out, but it's using the data that we have on historic energy price escalation and historic similar building type use to get the savings.
Great. One question from an attendee is on one of the earlier slides that you showed, where you could see that energy efficiency was making up a larger portion of the projects versus renewables. And essentially what that attendee wanted to ask is, are there reasons why funding for renewable projects is smaller? Is it because the scale of the investment needed? Do you think it's because of the longer payback period? And I guess a follow-up on my end to that, is that metric you were using, has that been changing at all, or has energy efficiency projects been kind of taking a larger portion of the CPACE work you're doing each year?
It's a really great question. We find that the share of renewable energy versus energy efficiency is honestly state by state dependent. So most of our renewable energy projects have come from states like Connecticut and Rhode Island that have very strong incentives for renewable energy, and PACE is a really nice fit for those incentives. The other thing that those states have is higher power prices, which makes renewable energy a much more attractive investment. As we've moved into other states with lower power prices, states like Ohio and Texas, we're seeing a smaller share of solar and renewables in those states, and a higher share of air conditioning and envelope upgrades and other HVAC measures. So for us, that's what's really driving the difference and the shifting. And it's the question about kind of how it's shifting over time is a really great one as well, because I think there's also an element of many early adopters tend to be early adopters of financing tools and technologies. And so many of our early kind of PACE borrowers were really excited about doing solar. And as the product has moved more towards the mainstream, we're also seeing kind of more quote unquote mainstream measures as well.
Great. And kind of, I guess, a little bit going off of that question, one of our attendees writes, agreeing that the financial for PACE seemed to make sense. This attendee is asking, is there a sweet spot in terms of project size? Can you discuss streamlined processes and whether this translates to a faster cycle time for smaller projects versus larger projects?
Yeah, it's a great question. We are really set up for kind of the $600,000 average size PACE asset. Certainly, we're starting to see more efficiencies at the smaller end. So and I would think about smaller end not only in project size, but also in leverage ratio. So again, our security is the building, and so we are looking at our leverage, our kind of overall exposure to that building. And so I think for us, the sweet spot is about $600,000. It's still a relatively robust underwriting process that we go through internally. We're streamlining that where we can, just in terms of using technology to standardize the checks that we do. But it's still a lot of, it's fairly expensive to originate. So we need a little bit of size to amortize that origination cost. And then I think as you get into larger PACE assets, those buildings that can support a larger PACE assessment tend to have more efficient access to capital because they tend to be kind of a larger owner, a larger developer. They're potentially owned by a national chain, and they can access the capital markets much more efficiently. So they may not need PACE, or they may not kind of want to go through the headache of asking their mortgage lender to consent to something. So I think there are all sorts of reasons why for us the $600,000 number makes sense. But we are starting to see more and more folks at both ends, so the smaller end and the larger end, be interested in PACE because of the structural value it brings. And the market is starting to evolve to adopt those into the underwriting criteria.
Great. And getting a lot of questions, which is always wonderful on our end.
Great.
So a lot of interest in CPACE. A few questions, and I think they link together rather well. But talking about when Greenworks Lending has attempted to go into a new PACE market, how do you approach that issue? How do you decide, when it's the time to go into a new market? And then a kind of side additional question to that is what you think municipalities across the country can do to promote PACE if they don't have it?
Also a very good question. When we decide to go into a new space, we'll do a very deep dive legal analysis around that state, but typically the driver of that deep dive is that we've built up already a pipeline of projects, either from one of our public sector relationships or from a contractor partner on the ground. And we'll start to have eyesight into what the deals look like, what the assets look like, what the borrowers look like, do they meet our underwriting criteria? So we tend to feel that there's a near-term pipeline there for us, and that's when we start to do the analysis. On the kind of municipal side, it's a great question, and many of our most successful programs have been when the municipality is engaged and engaging their chambers of commerce and educating them on PACE and their local business owners on PACE. It's very much, from our perspective and the size of the assets that we look at, it's very much a Main Street product. And so we tend to love partnering with municipalities and the organizations that they have to support their local businesses. And I think the education aspect is a really important one for the public sector.
And kind of going back to earlier when you were pointing about how Connecticut is hitting above its weight due to partnership with the Green Bank, do you find that having a green bank in a state has made a big difference in terms of commercial PACE? Meaning it seems like Texas and a lot of the other states do not. So wondering if the way you have approached projects here versus those states is a lot different, or if you're seeing kind of PACE standardized throughout the rest of the country.
So the thing that the Green Bank did for commercial PACE, and they've worked in all of the real estate sectors and have built programs in all of the real estate sectors. But the thing that they did for commercial PACE was set up a standardized administration platform. And most of the states that are operational for us have standardized administrators. And what that means is that there's one entity that has that owns the operations in that state. So all of the municipalities or the counties, wherever the taxing takes place, is funneling through kind of one administrator. One administrator is setting up the rules of the road. They're the ones who are kind of interfacing with the technical review and the municipalities. And so it creates a standardized platform. It doesn't necessarily have to be a green bank, but the Connecticut Green Bank really kind of set up the model for a standardized administration platform that we prefer and we've looked for in many of the states that we've been in.
Great. So a question about the recent securitization that your company achieved. One of our attendees asked, looking long-term, what are the key metrics to standardize to garner interest with investors in CPACE loan securitization?
So I think like many asset-backed security classes, the thing that will kind of be the metric is performance. Our performance history has been very, very strong in commercial PACE, and we expect that with our underwriting that will continue. So I think that that's number one. And then second to that, of course, is that origination, the volume. So are we able to attain the volume seen with other ABS asset classes? which will result in a strong and robust capital markets and secondary market for the asset class. So I think that those two are the main things that investors will look at when assessing this asset class in the future.
Great. Lots of different questions coming in. So just working our way through these.
Sure.
An attendee is asking, do you see opportunities for efficiency in the underwriting process? They offer auto underwriting software as one potential efficiency.
Absolutely, yes. We have not found any software that suits the needs of our process. So we started to look internally around areas that we can standardize and rely on technology. But as I mentioned earlier, that the big challenge with the SMB market is, of course, the variety. That's looked at quite favorably from kind of a rating agency perspective, because you're not reliant on any one business type or property type or even geography. But it does mean that there will always be some sort of manual processes in the underwriting. That said, as we have more and more reps under our belts, there are a couple ways that we've standardized our document collection, our initial screen of the property, and our internal kind of project management of the assets, and making sure that we're able to parallel process different parts of the sales process.
Great. Two other questions I think also have are a little bit more process question about CPACE. The first is, which type of buildings do you typically see taking CPACE? And then another attendee asking about the riskiness you've seen so far. That attendee was asking if you've seen any defaults, which they're defining as being more than 90 days behind in their payments.
That is awfully specific. No, we have not seen defaults yet, which is, I think, consistent across most of the PACE providers in the space. And again, gets to the underwriting and the work that both the administrators and the PACE providers do in ensuring that that the borrower knows kind of the structure, the lender is consenting, and the asset is underwritten accurately. What was the first part of the question? I'm sorry.
They were asking about the types of buildings that you see typically taking on CPACE.
Got it. So our portfolio is fairly varied. The largest type tend to be tenant-occupied office buildings. That's about 30% of our portfolio and our pipeline. But we are starting to see other types of properties like manufacturing, industrial, storage, some kind of other types, which we include schools, churches, hospitals, the quote-unquote mush market. It definitely runs the gamut of the commercial market segment. But ours tend to be kind of the tenant occupied because of that structural feature of being able to pass down both the savings and the cost to the tenants.
And that's a great segue into another question that just came in, asking, and if it's kind of covered in this last answer, feel free to note that. But if you're a tenant interested in PACE, what would the appeal be for you?
So the tenant would get the net savings of doing PACE. So they would, in most cases, receive the energy savings, which would outweigh the cost. So they would receive an annual savings from doing PACE. And then the owner would receive an improved asset. So when that tenant moves out, they have a building that's been improved and is much more valuable.
Great. So another question from an attendee is kind of more about the Connecticut CPACE Fund. And they want to ask if any of that money goes towards kind of on the efficiency side towards either fossil fuel or gas. They're just kind of curious about what exactly kind of can be considered PACE.
Sure. So if I'm understanding the question correctly, the CommercialPACE can go to fund anything that saves energy on a property. So if you're switching from a less efficient oil boiler to a more efficient oil boiler, you can use CommercialPACE. But a lot of what we've seen are oil, and some of what we've seen are oil to gas transactions. So converting the HVAC system from kind of less efficient oil to more efficient natural gas. And so, you know, certainly we do see some fossil fuel transactions, but it will always result in using fewer fossil fuels. And the other thing that that PACE is great for all of these projects is, and we haven't talked about a lot, but is the ability to fund soft costs, so to fund the labor associated with those transfers from oil to gas, and that results in a lot of economic development that's not just related to saving energy, and was one of the, and I think still is one of the goals of the Connecticut governor.
Great. And we've received a ton of interest, so want to thank you again, Alexandra, for answering all these questions. I think going to kind of wrap up with a more general question about where you see the market going over the next year to 5 years, given the big securitization deal that you and your team made. Do you at Greenworks Lending anticipate more of those? And what do you kind of see as the next big thing?
Yeah, great. Well, again, and thank everyone on the line for all of your interest and the great questions. We think that this securitization is just the beginning, not only for Greenworks, but also for the CommercialPACE industry as a whole. We always saw this as a goal for Greenworks. We achieved it a lot more quickly than we expected, which I think is a testament to the growth of CPACE across the country, to states passing policies and getting excited about what this can mean for their economic development and energy goals. And then, so we think it's just the beginning. We expect that there will be a lot more CommercialPACE transactions in the future, many of them from Greenworks Lending.
Wonderful. Well, thank you everyone for joining. This concludes today's talks on CPACE, financing sustainability while fostering economic development. Ms. Cooley, thank you again for joining us today. We also want to thank everyone for their great interest and many questions. We received a really high volume, so we tried to get it to as many as possible and really appreciate all of your input. We will forward any of the remaining questions to our speaker. And to view a recording of this webinar, please visit the Events tab on the Yale Center for Business and Environment website, or access the recording through Yale iTunes University Podcast. Typically, these go up a few days after our presentation. Thank you again, everyone, for joining us. Until next time, this is Corey Cantor from Yale Center for Business and the Environment.